Hi everyone, so in this video I'm going to talk to you about how to identify opportunities in the stock markets and really guide some of the thinking around there in terms of how to think about investing and how to identify all those opportunities. So when you come into the Stone Alpha dashboard, you're going to click on here. You may come to the market overview page, but click onto stocks. You'll come across something like this. If you don't, then click on the screener over here, and then eventually you'll come across this table. Now, this table is a universe of about 400, maybe 450 stocks, 453 stocks from the US markets. It's very comprehensive. So like if we look here at, say, NVIDIA, it will give you about 80, 90 pieces of information about that company, how many employees they've got, what their R&D budget is, and just a whole load of things about their balance sheets and things like that. So you can really drill down into the company itself. So the reason this is really strong for you is that typically when you want to invest in a company in this day and age, someone's going to take some guidance from an influencer, and that may be good guidance, but it's not comprehensive guidance. Or they may go into ChatGPT and it's just going to, as I said, give you a whole list of stocks that you already know. But here, when you are looking to invest in a stock, you want to think about it as if you are buying the whole business. So if you wanted to buy NVIDIA tomorrow, you're going to need $5.1 trillion. That's the market capitalization of the company. You're going to need $5.1 trillion, which I'm guessing you haven't got, nor have I. So instead, what we're going to do is we haven't got $5.1 trillion. So what we do, we buy one share in the business for $212. Now, here's the thing. We don't know at this stage whether or not that is cheap or whether or not that is expensive. We know it's $212, but what are you getting for $212? That's the question every investor needs to answer. Otherwise, they're not an investor, they're a gambler, because they don't know what they're going to be buying for $212. So imagine for a second that you're looking to buy a coffee shop or an ice cream van or something like this. The owner, he or she, let's go with she, says, I want $200,000 for this coffee shop. Okay. And you're going to say, okay, how much is it making? And she says, right, it makes about $500,000 a year turnover. And we spend X on coffee. We spend X, Y on this and that. But by the end of the year, we are left with $100,000. And I say, okay, you want $200,000 of my money to buy $100,000 of net earnings, whatever's left in the business. And she says, yes, that sounds about right. So we could reframe this and say, okay, why didn't you just say you want 2 times what your business is earning? So we could play that conversation back. I say to her, how much do you want for your business? And she says, I want 2 times $100,000. Okay. The reason that's important, that 2 times, that multiple, because you get an understanding, okay, it's going to take 2 years for me to pay that back, right? So now that's called the PE ratio, the price to earnings ratio. How much you're going to pay for a certain amount of earnings. What's that multiple? What does that look like? Okay, so in the case of NVIDIA, you're going to be paying 32 times what they earn. Okay, that 32 times what they earn is basically $5.1 trillion, or if you divide it in a load of shares, it's $212. Okay, so you're paying 32. So it would take you at the current rate of what they earn. So what they're earning $6.50. Excuse me. They're earning $6.53 a share over here, and you're paying 32 times that. So 32.6 times $6.53, what they're earning per share. Let's go back there, sorry. Equals, it should equal $212 or thereabouts. You do the numbers, but that's what it should equal. So it shows you're paying a multiple of 32 times what they're earning. That's a very, very important multiple, okay? Because it says that people are willing to pay this right now. People love NVIDIA so much, they're willing to pay 32 times what they earn. Okay, so do you understand that concept? That's the crucial concept. Now you know how to value a business. So what we're going to do, we're going to model that out. We're going to say, okay, we're going to go into NVIDIA. Same concept here, by the way. See, that's what they're earning, $6.53. All right. The PE ratio is 32 times. So this times this equals the price, which is here. Okay, so that's what they're earning. However, there's a little bit more now. Okay. Everyone thinks they're going to be earning, their next announcement's going to be $12. In other words, that's the growth. They're going to grow about 100 and something percent. Okay, and if you look at the trajectory of their growth here on a quarterly basis, you can see actually that probably makes sense. They're going crazy, this company. So people are saying they're going to earn, or analysts are saying they are going to earn $12.65. In other words, at the current price, okay, at the current price, $212, and a forward earnings price of 12, that PE ratio changes. It changes to 16. Okay, so hey, we've got a little secret here now. We think they're going to be earning this, and it's priced at that. But hey, that gives me a ratio. That means I can pay 16 times. So now, historically, everyone's been willing to pay 32 times. But we know that that ratio is going to go down to 16 times because they're likely to earn this, right? They're likely to come out this. And this is where the kind of analysis comes in. You assess how they're behaving as a company and what they're doing, and you assess the trajectory here. You don't get this information so easily elsewhere. So you assess that trend and you say, okay, they're going up. Let's look at their growth. There's a bit of growth here. This is quarterly basis, by the way, so I'll keep to that. The yearly, remember, we've only had one, look at this, we've only had one quarter so far, so the year's not up. So you could see these guys they're serious. They're a serious company. So going back to the ratio, I could buy this company. It's not 32 times. It's 32 times if they stick at $6.53. It's actually 16 times. So it's kind of like gone cheap relative to what they are likely to be earning. Okay, so just take a moment to internalize that. This times this, 653 times 32 times earnings, you are paying 32 times their earnings to get, and you're going to pay $212, right? Forgive me, I don't want to be patronizing here, but I know the community I'm speaking to, so I'm repeating some of these concepts at this level. Okay, so $212 is equal to the current earnings times 32. And this 32 number is just a consequence, right? It's a result of the price. And similarly, you know that they're going to be earning this. So they're going to be trading at 16. Right, I'm going to move on now, okay? Now we know tomorrow comes, we are paying $16, which is this current price. The price doesn't change, the multiple changes. What I'm going to say now is that we know historically people have been willing to pay 32 times, right? So we move this model here. Actually, let's go a bit further than that now. Let's go a bit further. Let's go back to the screener. You'll look here and look at the screener. You can see here people have actually in the past been willing to pay 75 times what NVIDIA earns. But it's unlikely to reach back there because we know it cannot just keep going up. Okay, so back then, people were willing, 3 years ago, at some point, they were willing to pay 75 times what they're earning. Some people were willing to pay that premium. Now, however, the average over the last few years has been about 46 times, right? Today, based on what it's earning, it's at 32 times. So if we take this up to the average over the last 3 years, we get a price of $531, right? So can you see that, okay, based on the forward, it should be because 42 times earnings is not ridiculous. We know people are paying 32 times today. So people should be willing to pay. Okay, let's go down to 32 times. We know that people are willing to pay this today. So it should be $412. So that's why. Well, that's one reason why NVIDIA is cheap. That's one reason. Why do I say that? Because other components come into this, like how much are you paying for the growth? How much is money going to be worth in the future? So there are other aspects to this. I don't want to confuse the conversation just yet, but just based on this alone, you can see, hey, we've got a deal here. We've got a deal to be had. And what's more, we've got another thing here is now the reason people don't like just price earnings ratios on their own is because it doesn't necessarily translate into healthy cash, right? You could see the yield on the cash right now. They're very heavily invested. So what I would do at this stage, I say, oh man, that's quite low. You know, there's not a lot of cash left. The burn's probably high, but hey, I know they can get cash, right? I know they can get cash, and then I'll go right here and just say, okay, where's that cash going? And we'll see maybe something like, oh, 20 billion of it at least has gone in R&D. So we know they're spending wisely and they've had a brilliant return on their R&D. But I'm not going to confuse the conversation around this. Just a quick one on PEG. PEG is basically telling you how much, so a PE ratio tells you how much you're willing to pay as a multiple of earnings. The PEG ratio tells you how much you're willing to pay for the growth. Right, so we'll do that in the next video. Another interesting one here is the 52-week range. You can see where it sits in that. So typically, if you're coming here and you want to look at the stocks, you could either download the CSV and just get the analysis done. I'm going to be doing that as well every week. You can follow on Substack. The subscription is going to be around $12 to $15, depending on how you have located this product. There'll be different deals through different influencers out there as well. So keep an eye out on that. But typically on the Substack, it's going to be, I'm going to be writing about all of this every single week. And not just this, not just opportunities, but we're going to go through structural intelligence. We're going to look at the market detail, where are the hedge funds positioned right now, where are they short. We're going to look at the crypto markets to see why it's probably a bad idea right now to be buying Bitcoin. Look at the short. Actually, it's calmed down a bit, but it looks like it's kind of peaked. At this point, you could see it was they were squeezing out all the shorts. So I'm guessing recently it has peaked and started coming down a bit now. But okay, so that's it. But look, you're going to have questions. Come back. Tell me what you want to hear, and I'll go through that. And just one side, look, there's so much more here. You could go the technical signals as well. We're going to show you where there's been volume spikes. I've got volume spikes here. There's going to be a volume multiplier. So if volume has gone over, say, two times, for example, here, you could see that GFS, is it? GFS has had 3 times its volume recently. Volume is a massive indicator of what's likely to happen to a stock. Let's take a look at this. Yeah, so someone's probably selling it aggressively right now. But we could do that analysis at another time. But can you see here the volume spike? It's a brilliant indicator when you know how to use this as well. So I will have a link to go from here back into the price modeling tool as well. All right, so that's that for now. Hopefully I've explained some good stuff there, but we'll stay in touch. Look out for the Substack link when that goes live. I'm going to start posting this every single week.